Alright, these are the solutions for the in-class problems that we weren't able to go through in Chapter 6. So we're going to start with exercise 6-16. The questions have been appended to the Moodle file down where the video lectures show up. So you should be able to see them there. There's a way I can show you them in this recording. Yeah, well, maybe. Let me just pause it for a second. Alright, here we are. We're in the Moodle page for the Business 353 course. Down in the in-class problem solutions, I've added a couple of files, Word documents here, and here you can see they are Business 353 Chapter 6 problems for the video that we're going to be going through shortly, and here are the Chapter 7 problems for the video which we'll go through shortly thereafter. So I'll post the videos in here too, and so that will kind of walk you through the logic in completing the questions. Okay, so the Word document that I was referring to, oops, something happened. That wasn't supposed to happen. There we go, back straight up again. These are just a couple of screen snaps from the Wiley exercises. So you can open up your Wiley Plus and find them there if you like, or you can download the documents where I posted them as I've just shown you. Anyway, the first question we're looking at is the one here, E6-16. We have a publishing company that publishes textbooks, and they sell them they sell them to bookstores, so university bookstores presumably, or college bookstores, and the price is set. It's FOB shipping point, which means that as soon as they're shipped, they are the property, the title passes to the purchaser. Payment is due 60 days after shipment, and the retailer may return a maximum of 30% of the order at the retailer's expense. So presumably they have to get their order fairly right, so they're not ordering a bunch of extra just in case. They can only return up to 30%. Sales are made only to retailers who have good credit ratings, so there's no issue of collectability. Past experience indicates normal return rate is about 12%, and the average collection period is 72 days. The company follows the IFRS standards. So the first question is, identify the revenue recognition criteria that Udin could employ concerning textbook sales. Well, there are two things that are required for performance. One is to ship the textbooks, and the other thing is to accept return of any that won't be sold, presumably. So they have a refund liability that they need to set up, but they can record the sales for the rest of them. So they're going to set up a refund liability, and the potential inventory returns should be used to reduce the cost of goods sold, so you don't recognize any of the profit on any of the goods that you're expecting to receive back. So 12% of the returns, or 12% of the sales would be expected to be returned, and then of course when they actually get past the return date, it doesn't actually say what the return date is, but presumably at the end of the college book purchasing season they'll be sending them back. Okay, so the first question, revenue recognition criteria. The performance obligation is first of all to ship the textbooks, and second of all to accept any returns that are returned and refunded, and refund them. So we're going to have to set up the logic, or we'll set up the journal entries according to that logic. Okay, so the reasoning for the answers is the sales process is broken down into a number of accomplishable jobs or processes that must be performed. So performance obligation is the name that is used for each of those things that they have to do. So the performance obligation determines that they can record revenue for the the books that they don't expect to get refunded. So when they get the books off their dock onto the purchaser's truck, the title transfers at that point. So that's what FOB shipping point means. And then when they receive the returns, they will refund any overpayment at that time, and of course put the books back in inventory and reduce the accounts receivable. So then the next question is, on July the 1st, 2017, Udin shipped books invoiced at $15 million at a cost of $12 million, and they're asking us to prepare the journal entry to record the transaction. And then we'll come back to this in a moment. So we've done A and B. So we will leave that, and we'll move on to C. C, please. C. There we go. So we're gonna. How did I get a kick out? How it does that? Don't do that. All right, and then let's make that a C. Okay, good. So we are going to set up the accounts receivable. So we're going to debit something, and we're going to credit something. We're going to debit the accounts receivable. Good idea to spell I before E, except after C. And words like neighbor and way. Is that enough zeros? I don't know. Let's check. Let's make these. We'll make them into commas and then get rid of the zeros. There we go. This 150 million. That's too many millions. Take off 1 million. Okay, so the accounts receivable is 15 million. I guess we probably, not quite sure why I put it over there. Let's get that out of there. Okay. I'll put it over here. Out there. Out there. There we go. Okay. And of course the credit side goes to sales. So we record the sales revenue. But we are expecting 12% of them to be returned. So we're only going to record 88% of the value. So 15 million times 80.88, oops, 88. 13,200,000. Of course, the rest is set up as a refund liability. It's essentially unearned revenue. So it's a liability to return or to accept return of the goods if they don't take them. So you can do that calculation either as 12%, probably the easiest way. 12% of 15 million. $1.8 million, and then you have a little description here, and of course the date would be 1 July 2017. Alright, so that's the first one, and then the next journal entry on the same date, we need to record the cost of goods sold. So we have a debit to cost of goods sold, and we have a credit to inventory. And it tells us that inventory goes down by 12 million. So the cost of goods sold is part of that. I think we probably need to slip in another line here because inventory is the biggest number. Okay, so cost of goods sold is for part of that, 88%. So once again we can just put a little note to ourselves, 88%. And the rest would be an allowance for estimated inventory returns, which is sort of like a, I don't know, the logical opposite of unearned revenue. Kind of, we're expecting that inventory to come back, so it's possible that that might be changed into an expense in the future, but it's we're essentially saying that it's our inventory. So it's like inventory on consignment. It's still our inventory, even though it's in the hands of the customer for the moment. And so that would be 12%. So 0.12 times 12 million, because it's the cost side here. Whoops, forgot the in Excel you have to tell it that you're actually doing a calculation. And then I think that's enough. Put it in as 0.88. So those two should add up. You can tell, I'm not sure if you can see it on the screen here, but in Excel, if you highlight them at the bottom of the screen, way down here, it shows that the sum is equal to 12 million. Let me see if I can make that slightly larger. There, you can see it. So the sum is actually listed at the bottom. So it's $12 million, which means that we've balanced our journal entry. And that is the answer to question C. Let me bring it back. Oops. Not quite sure what happened there. There we go. That's the one I want. So that was C. Then D, it says, on October the 3rd, 2017, 1.5 million of the invoiced July sales were returned according to the return policy, and the remaining 13.5 million was paid. So that was July, August, September, October. It was almost within the 60 days. A little more, about 65 days. So it was a little overdue, but not bad. We're supposed to prepare the journal entries for the return and payment. So let's go do that. So this is D. So bracket, D bracket, D bracket. We're going to debit some things, and then we're going to credit some things. The fact that we got some of our goods back, 1.8 million was the total refund liability that we set up, but the question that we were just looking at told us that they sent back 1.5 million. So the refund liability goes down by the amount that they sent back. 1,500,000, 1.5 million, and we're going to credit the accounts, or the accounts receivable, so they don't have to pay us for that because they sent it back. Okay, so 1.5. So we've satisfied our refund liability by reducing the amount of money that they owed us, and accepted the inventory back. So we've got to get our inventory back. So we put the inventory back in, and we credit estimated inventory returns. And we have to do some calculations here. So in Excel, if you hit the apostrophe, then you can actually type and you'll be able to see what it is. So this, we estimated the value of the inventory by taking the fact that the inventory was $12 million out of the 15 million. So we need to figure out what the cost of the inventory they received was, or they returned was. So we're going to take the 1.5 million and assume that it's the same proportion as the 12 million was out of the total 15 million in sales. So that should work out to 1.2 million. So let's see if that works. Equals 1.2 out of 1.5 times 1,500,000, $1.2 million. And in Excel we could just write in that lyrics, we could just drag it over there, but there we do got the same calculation. We're not quite done because we have actually recorded some receipt of cash. So the amount of cash we got was the accounts receivable of 15 million. So we got 15 million minus the refund of 1,500,000. That worked out 13.5 million. Okay, and of course the credit goes to accounts receivable. So let's check to make sure that the accounts receivable is taken care of. we set it up for 15 million up here. It went down by 1.5 million through the refund and down by 13.5 million through the receipt of cash. And now we do have a remaining question. Now you're probably wondering, what do we do with the rest of the estimated inventory returns and the rest of the refund liability? Well, the question says that we still have an ongoing liability. It says that they may return a maximum of 30%. We've set it up for 12%, and they didn't actually use the 12%. They could return up to 30%, but our estimate is 12%. So at this point, there's nothing indicating the completion of the performance obligation for the remainder of the refund liability and the estimated inventory returns. So we haven't actually determined at this point whether or not it's a sale or whether it's a potential future return. So it's possible that they still could return the amount. We don't have any indication that they've actually finished selling them all. If there was a date after which the return was no longer possible, so there was kind of a drop-dead date for the return, then at that date we would record the refund liability would be satisfied, and we'd record that as sales revenue, and the estimated inventory returns would be cost of goods sold at that point. So then we could record the sale for the final performance obligation, which would be the end of the obligation to accept returns. So that's all there was to that question. Now moving on to 6-22. On May the 31st, we've got some consignment sales. So the question is down here. So Eisler Company consigned 80 freezers costing $500 each to a company called Remmer's Company. And the cost of shipping the freezers, of course, that's part of the expense of getting the inventory ready for sale, so we're going to add that to the cost of the inventory. And it was paid by us. Eisler Company is us. So the freight gets added to the cost of the inventory. And then on December the 30th, we received a report from Remmer's, and Remmer's told us that they had sold 40 of our freezers, which is good. They still have another 40, and they've been sold for $750 each, which was good because we are making $250 each for those. And it says remittance was made to by the consignee for the amount after deducting a commission of 6%, advertising expenses of $200, and total installation costs of $320 on the freezers sold. So we're supposed to calculate the inventory value of the units unsold in the hands of the consignee. So presumably half of the units, so 40 was sold. We shipped them 80, 40 were sold, so there's another 40 freezers that are still on hand. It's our inventory. It's inventory under consignment, so it may be in a different category in our books, but it's still our inventory. Then it says calculate the profit for the consignor for the units sold. So we'll have to take out the expenses, the commission expense, the advertising expense, and the total installation cost as an expense, and that will tell us how much money we made on the freezers. And of course the cost of the freezers will have to be taken out as well. So 40 freezers at $500 plus half of the $740 freight cost. Then it says calculate the amount of cash that will be remitted by the consignee. Well, that's the $750 for 40 freezers after you deduct the commission, the advertising expense, which they need to be reimbursed for, and the installation cost of $320. So that should be all of that. So let's see if we can do those calculations. Once again, you may want to open this document as you're reviewing this video. Okay, so back to Excel. And here we have exercise 6-22, and let me just scroll up. There's lots of room in Excel. And first question A was what the total inventory cost. So inventory cost, and this is for the remaining freezers. So we can do that calculation one of a couple of ways. If we recognize there's 40 units remaining at cost of $500, that would tell us that 40 times 500, or $20,000. And then we have the freight, which is going to be 40 out of 80 times the total 740. So equals 40 out of 80, whoops, out of 80 times 740. Be nice if I could type my numbers. Alright, so then we just add that up. Pop up here to Excel. Where's my, there's my, okay, let's do the double. Okay, there's that fancy double underline thing, and then we'll just hit the sum. Add those two up, 20,370. Then question part B was, what's the profit? So the consignment profit. Well, the sales revenue was 40 units equals 40 units times 750 each. Okay, and then the cost of goods would include the cost, the inventory, which is 500 units, so 40 times 500 plus, whoops. Once again, I forgot the equal sign. So 40 units at 500 plus 40 out of 80 times 740. So basically the same 20,370 as we have up there. Looks like I may need to make this, there we go. Okay, so 20,370, and then of course we have the commission, which was 6%. So equals 0.06 times 30,000. And then we have the advertising expense of, I believe it was $200. And the installation expenses were 320. So let's hit the sum key and then highlight all of these. There we go. It cost us 22,690. And so then we get our final summation here. We're going to add the 30,000 and subtract the 22,690 for a total profit of $7,310. And then the final question, part C, was how much cash? Consign or, well, we're going to get the sales, and we have that up here, so let's just copy that. Copy that. Pop it down here. We also have all of these costs. So let's go right there. So all of those costs, the commission, the advertising, and the install, are costs that we have to pay the consignor. So once again, we highlight all of these, and the total deductions are 2320, like that, and then we want the 30,000 minus the 2320, and that gives us 27,680. And once again, our C disappeared and became a copyright symbol. Very cool. So that was exercise 6-22. Fairly straightforward question. So now let's go back and take a look at the next question that we have to deal with. This one is the recognition of the profit on a long-term contract. So we have a non-cancelable contract entered into by Shanahan Construction. It began January the 1st, 2017. They're building a parking complex, although that doesn't really matter. It's been estimated that the complex will cost $600,000. Will take 3 years to construct. The complex will be billed to the purchasing company at $900,000. So the cost is estimated to be $600,000, 3-year life. And the data that's given here, the costs to the end of 2017 are $270. An estimated cost to complete is $330. So you add those up, that's $600,000. So you've got $900,000 of potential billing, charged, invoicing, asking for money. $900,000 minus $600,000 works out to a profit of approximately $300,000. The progress billings to date is how much we've actually sent them invoices for, and so they owe us $270,000, and they still owe us another $30,000 because they haven't paid it, but they did pay $240,000 of the amount they owed us. Moving along through time, 2018, we have total costs of $450,000 and $150,000 left. So that's $600,000. Looks like we're still going to make our $300,000 profit. $550,000 of progress billings, and of that we've collected $500,000. So they still owe us $50,000. Then in 2019, we've expended all of the costs, $610,000. We've billed them our whole $900,000 and collected the whole $900,000. Nothing left to collect. Now the Lyrics Lab actually has a somewhat more complex one than this, and so you may want to review the video that I have prepared for the Lyrics Lab question number 6. It actually has a situation where they discover partway through that they're going to actually lose money, and so they need to record the loss at an earlier period. But in this case, we're still making money, which is good. Using the percentage of completion method, calculate the estimated gross profit that would be recognized during each year of the construction period. So the estimated gross profit is what we're calculating. And then B, using the completed contract method, calculate the estimated gross profit that would be recognized during each year of the construction period. Those are a couple of parts of the Lyrics Lab, but as I said, the Lyrics Lab is a little bit more complex than this. So take a look at my video if you are having difficulty with that Lyrics Lab question. So let's go back to Excel. Lots of room in Excel, so let's just scroll up a page. This is problem 6-9. So problem 6-9, P6-9, there we go. Alright, so A is the percentage of completion one. And we're calculating gross profit. So let's put in some headings here. This will be 2017. Oops. Somehow we don't have our... Okay, how do I make that go away? Let's just go back over here. Okay, so 2017, 2018, 2019. There we go. Okay, good. So the price is $900,000 all the way across. So I wonder what happens if you just drag it across. It'll probably add one. Oh no, it did. That's good. Okay. So then the cost. Let me just give myself a little bit more room here. We have cost to date, and then we're going to add in the estimated completion cost, and that'll give us the total cost. And then the estimated gross profit. And then recognized GP for gross profit. Alright, so let's fill in some information. Not that, stop that please. Alright, so $270,000 is the cost to date in 2017. Spent $450,000 at the end of 2018, and $610,000 at the end of 2019. Now, if we want to get our nice format back again, there we go. So then the estimated completion costs at the end of the first year, we had another $330,000, and at the end of the second year we had another $150,000. So we hadn't changed our mind, and of course we're all done at the end. So then we can add them up. Hit the sum, and we can drag all of this across. Look at that. Okay. So the estimated gross profit. I guess we didn't really want to have that. Let's do this way. Okay, there we go. Yeah, that's what we want. So then we take the $900,000 of total billings for the whole, or the price for the whole project. We expect to make $300,000. Let's just drag it across. Turns out we didn't. Oops, what happened here? Grab the little brown, green corner square, drag it across. So at the end of the second year, we still expected to make $300,000. At the end of the third year, we had a bit of a cost overrun, so we have to take a $10,000 hit on our profit, but that's not bad. So now we need to figure out how much of the gross profit we're going to recognize in each of the periods. Whoops, that's not really what I want to do there. So let's go there. So in the first year, or the first period, we're going to recognize 270. So we recognize 270,000 out of the total 600 times the 300,000 in profit. So that works out to 135,000. Now in 2018, we're going to recognize the interesting, didn't actually pull my single line across there, that's better. In 2018 we're going to recognize that 450 out of this total 600 has been expended. Once again, we multiply that by 300,000. But then we have to subtract the fact that the previous year's billing of 135,000. So we're going to recognize another 90,000 in the second year, and then in 2019 all the rest of it gets recognized. So we've got 100% of the job completed, and so we need to recognize 290,000 minus the 135,000 we recognized in the first year, minus the 90,000 we recognized in the second year. And that's all there is to it. So that's the recognized gross profit. So that's the gross profit we recognized in each of the 3 years. B asks us, what is the gross profit we would recognize in each of the 3 years for the completed contract method? And of course 2017, 2018, boy, 0 and 0, and then all of the 290,000 would be recognized in 2019. Okay, that wasn't quite what I was looking at here. Okay, somehow I got this. This is 290,000. Alright, and for some reason my notation isn't staying, so there we go. So we know that the total amount of the profit is 290,000. It's all recognized in the final year of the contract 2019 under the completed contract method. And that was all the remaining problems that we had to deal with in Chapter 6. So my video is now done.